Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. Now today, we're going to dive into the world of fixed income and explore why it remains a critical part of investors' asset allocation. Fixed income not only generates income, but also brings a lower level of volatility to portfolios. As we anticipate the US Federal Reserve resuming its rate-cutting cycle in the months ahead, it is worth exploring the various options in fixed income for APAC investors. Now, as a reminder, many of the data points and trends I've mentioned in this podcast are also available in our daily guide to the market. We'll provide a link in our show notes. Now, at the start of this quarter, we recommended a barbell approach to fixed income allocation. This involves a combination of developed market government bonds and high-yield corporate debt in developed economies. The high-yield debt generates income and takes advantage of the relatively benign growth environment, while government bonds, including US Treasuries, provide insurance against economic recessions. Given the prospects of rate cuts by central banks, we're more comfortable also with gradually lengthening the duration of government bonds. Now again, if you look at our daily guide to the markets, you find the returns have been positive and better than cash across the fixed income world, both in the past 3 months and also year to date for 2025. Now let's discuss 3 specific questions on fixed income. US Treasuries in the face of lower policy rates, high-yield corporate debt given the very tight corporate credit spreads, and also the prospects for local currency, emerging market, and Asian fixed income. Compared to the summer of 2024, US Treasuries' reaction to the prospects of rate cuts have been more muted. This could be because investors are focusing not only on the downside risk to growth, but also on the potential upside risk to inflation given tariffs and their impact on the cost of imported products. Also, concerns over sustainability of US federal government finances could also lead to investors demanding a higher risk premium or term premium for holding longer dated bonds. Now, this could also limit how far US Treasury yields could fall when the Fed start cutting rates in the months ahead. However, we still see value in investing in US government bonds for 2 reasons. Number 1, the level of yields continues to be attractive, and US Treasury market remains the most liquid and the deepest government bond market in the world. Additionally, bonds provide protection against downside risk to growth. For high-yield corporate debt, the current level of credit spreads is close to its 10-year low, implying limited upside to bond prices in capital gain from credit spreads compression. Much of this year's return for US high-yield corporate debt comes from income, which is exactly what we've been expecting. This return contribution from income is likely to continue. If credit spreads widen, leading to a mark-to-market loss in bond price, the income from corporate bonds act as a buffer. The current default rates for US high-yield corporate debt is around 0.4% compared to the long-term average of 2.4%. Even if default rates rise to this average, the income yield of around 7% is more than enough to cover the potential price declines. For investors that are less sensitive to price volatility with a longer investment horizon, high-yield corporate debt still offer a good opportunity for income generation. What about emerging market fixed income? Emerging market debt, both in local currencies and the US dollar, have been the star of fixed income investing in 2025. A weaker US dollar in the first half of the year certainly helped, prompting more capital inflow into emerging markets and Asia, as well as allowing those central banks to cut rates. Looking ahead, I expect the US dollar depreciation trend to pause in the coming months as investors assess the Fed's next steps and also to gauge the economic impact of tariff policies. However, in the longer run, we still expect the US dollar to weaken, supporting emerging markets and Asian fixed income, especially for the local currency variety. For valuations, the credit spreads on US dollar emerging market bonds are also relatively tight. US dollar Asian high yields, even excluding Chinese real estate developers, looks less demanding with some room for tightening. Active selection becomes crucial in enhancing yields and managing default risk in this area. Overall, we see plenty of reasons and opportunities to invest in fixed income, with many options to meet investors' objectives. In particular, neutral duration developed market government bonds and high yield developed markets corporate credits offer attractive opportunities. In a weaker US dollar environment, local currency emerging market debt can also help to enhance income and return generations for investors. So thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues and also consider subscribing for more insights. If you have any topics that you want us to cover, please reach out to your JP Morgan Asset Management Client Advisor. I'm Tai Hui. I'll see you in our next episode to discuss what's on investors' minds. Until then, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.